With a stunning net worth of $108 billion, Warren Buffett is regarded as one of the best investors of all time. His success is largely attributed to his long-term holding of investments in businesses that have competitive advantages that can be sustained. Despite his company Berkshire Hathaway's decision to forego dividend payments, a sizable portion of its holdings do. In actuality, the dividend income from his investments exceeds $4 billion annually. Value investing is a term used to describe Warren Buffett. Selecting companies for this investment approach entails looking for ones that are trading below their intrinsic or book value. But as time went on, his approach changed. Heavily influenced by Charlie Munger through their investment in See's Candy, they were able to learn how to shift their attention to the underlying business's quality. Let's now explain why we think walking away from See's Candy would have been a terrible idea for them. For $25 million, they acquired the entire See's business in 1972. In that year, the company generated $31 million in sales and after-tax earnings of $2,083,000. In addition, the company required $8 million in working capital to run. Given Buffett's assessment of See's, it would have been foolish for him to agree to pay more than the $25 million he did. In 2007, See's Candy had generated pre-tax earnings of $1.35 billion for Berkshire Hathaway. Additionally, the company's revenues for that year totaled $383 million, generating a pre-tax profit of over $82 million. Therefore, each year Buffett more than triples the amount he initially invested in See's Candy. Based on this, it made no difference whether they paid $100,000 or $1 million, or dang it, even $10 million or more. Buffett later, in 2019, claimed that the chocolate company had continued to generate pre-tax profits for Berkshire Hathaway that are well north of $2 billion. See's Candy is a perfect example of what Buffett values in a company. Due to a strong brand and client loyalty, the company has developed a competitive edge. According to Buffett, what we look for in a corporation is a long-term competitive edge in a reliable industry. If it is accompanied by quick organic growth, excellent. However, such a business is lucrative even without organic growth. We will simply take its lower earnings and use them to purchase businesses of a smaller nature elsewhere. With See's Candy, he performed just this action. This idea of purchasing excellent businesses at fair prices would permeate all of Buffett's subsequent investments. Even though the company had little potential for growth, if the vast majority of his holdings paid dividends, Warren Buffett does not specifically target dividend stocks. This connection is caused by the companies he targets. Companies with dividend stocks are frequently established, mature, and have successful business models. Significant overlap with Buffett's preferred investment strategies should be believed. Approximately $4 billion in dividends are paid out annually by Warren Buffett's Berkshire Hathaway, as was noted in the opening of the film. Even the profits from businesses like See's Candy, in which they have full control, are not included in this total. The Coca-Cola Company, which Buffett has owned since 1988, is one of his best-performing dividend equities. With an original cost basis of $3.24 per share, this investment will provide dividend income for him of more than $656 million this year. Buffett currently enjoys a dividend yield on cost of 50.5%. This indicates that he's generating enough dividends to more than double his initial investment every 2 years. For more than 58 years, Coca-Cola has steadily increased its dividends, and there are currently no signs that this trend will reverse anytime soon. This is a perfect example of a long-term investment in a company with significant competitive advantages. Warren Buffett has made significant investments in Apple in 2016, and Berkshire Hathaway now owns more than 5.9% of the company. Although he has already realized a sizable return on his investment, I believe it has the potential to become his next Coca-Cola. He expects to receive $822 million in dividends this year, the highest amount of any of these holdings. Although we don't know his exact cost base, we may infer from the time he invested that his current yield on cost is between 2 and 2.5%. Apple has a huge following of customers and is currently the most valuable brand in the world. Additionally, it has a 9-year dividend growth history and a 5-year compound annual growth rate of 10.5%. If in 30 years Buffett doubled his initial investment every 2 years through dividends akin to Coca-Cola, we wouldn't at all be astonished. If you're interested in learning more about Apple, we also reviewed its stock and included a link in the explanation. Buffett has a variety of dividend-paying equities that have a high yield on cost. This is made possible by the long-term nature of his investments. Moody's, a company that provides data analytics and credit rating services, is another source of revenue for Berkshire Hathaway. Berkshire's yearly yield on cost is 22.3%, and it will pay out over $55 million in dividend income this year with an initial cost basis of $10.05 per share. Every 4.5 years, Buffett doubles his initial investment through dividends. Taking into account that Moody's currently has a price of about $270 and a dividend yield of 0.8%, his investment is a shining example of how making long-term investments may result in enormous cost savings. Buffett receives $260 million in dividend payments from American Express each year. The dividend yield on cost for Berkshire Hathaway is 20.3 at an initial cost basis of $8.49 per share. This indicates that with dividends alone, they will double their initial investments in slightly under 5 years. Other notable investments include Bank of America, which pays an annual dividend of $743 million, Wells Fargo, which pays an annual dividend of $659.3 million, Kraft Heinz, which pays an annual dividend of $521 million, U.S. Bancorp, which pays an annual dividend of $222.5 million, and J.P. Morgan Chase, which pays an annual dividend of $214.2 million. These are just a few of Warren Buffett's many dividend-paying stocks. The key lesson from this is that investing in businesses with long-term competitive advantages can result in enormous yields on investment and enormous profits.